Bloomberg Audio Studios.
Podcasts, radio, news.
Standard Chartered shares higher in Hong Kong after the London-based bank said that it would ramp up its multi-billion-dollar share buyback program. This as it reports a beat on second quarter pre-tax profits driven by its wealth business. And I'm pleased to say that we're joined now by the CEO of Standard Chartered, Bill Winters. Welcome back to the programme, Bill.
Morning, Lizzy.
Let's start with that buyback. $1.5 billion, a plan to return at least $5 billion to investors by 2026. Is there a chance you could go beyond that target now that you've got results like these?
Yeah, we set a 3-year target of in excess of $5 billion. We've done $2.7 billion in the first year so far. So, yeah, if we continue to perform well, what we've said to shareholders is we've got a strategy. We're pursuing the strategy. It's working quite well. Earnings are strong. We're managing our capital very, very directly and I'd say quite actively. And that's allowed us to return any surplus to shareholders. And we said, especially given where our stock price is, which is not as high as we think it should be, we will buy back as many shares as we can with surplus capital. That's what we're doing. If we keep on performing, of course, we can keep on buying back shares.
Yeah, I think earlier in the year you described the stock price performance as, and I quote, crap. So you're still not happy with it?
No, of course not. It's less crap than it was, but it's, we have a long way to go. And, yeah, of course, we have to ask the question, why? It certainly isn't that we're not performing well. So the performance is, we can do better. I will always recognize that we can do better, and we are doing better. Yeah, I think we're operating in a somewhat difficult environment. And I think we need to be clear about just how differentiated Standard Chartered is. And, yeah, at the end of the day, we serve multinational corporations on their cross-border needs, and we serve affluent individuals. We do that extremely well. We got a fully scaled and quite a substantial position across Asia, Middle East, and Africa, but also with multinational corporations coming out of the Americas and Europe. That's what we do. We're doing it well. It's generating good returns. We keep on going.
So do you have potentially a new target figure for the buyback target?
We haven't revised our target. We just set the $5 billion target in February. We're not going to fine-tune this thing every 3-6 months. What we said was we'll do in excess of $5 billion, and we're on track to achieve that. And as I said, we'll keep on going if we can generate the strong performance.
Okay. I want to ask how your Fit for Growth plan's going. So this is your plan to cut costs by $1.5 billion over the next 3 years. Yeah. Are you seeing much wage inflation, for example? We
have. We obviously had a big spike in wage inflation last year. This year is much more subdued, and that obviously is getting back down to normal. The Fit for Growth really is a transformation program. So we've had cost-cutting programs pretty much my whole time as Standard Chartered, and we'll continue to get more efficient. We're trying to do this one a bit different, though, which is actually quite a bit differently, which is to look at every single one of our processes and say, how do we simplify this? How do we replace manual processes with digital processes, automation, simplification, et cetera? How do we make it an easier place to get things done for ourselves, for our colleagues, for clients? That requires investment. So in addition to saving $1.5 billion a year, we said we're going to spend $1.5 billion up front to achieve that. Everything is on track. We've got over 200 initiatives that we're pursuing. Each one is quite small. I mean, these aren't like big marquee projects, but collectively it makes a big difference.
Okay. Let's delve into these pre-tax profits. A rise driven by your wealth business. Where are the biggest inflows geographically?
Biggest inflows for us are everything international, so what we call international banking. A big chunk from mainland China, investing in Hong Kong, investing in Singapore, to a lesser extent investing in Dubai, but that's happening. Global Indians, so the Indian wealthy population obviously growing very quickly. Again, across Dubai, Singapore, Hong Kong are 3 big wealth hubs, in addition to Jersey. But also the rest of ASEAN. I mean, the wonderful thing about our footprint is that there's a rising upper middle class. They're saving, in many cases, for the first time in their families' histories. And people who had some wealth before, of course, are becoming wealthier as these economies grow. And it just is playing right into our strengths.
I do want to come back to the China outlook, but on wealth, could you hire more wealth managers?
We are hiring more wealth managers. We've added we've grown the number of wealth managers by about 9% per year for the past 3 years, and we'll keep on going. We're focusing on the full spectrum from the ultra-high net worth, so private banking, through to our real sweet spot, which is the mass affluent. So people that have material savings but aren't in the family office zone. And we're very good at helping lift those individuals or families out of the states that they've been in, which have been typically not accumulating savings into investing substantial amounts.
And you've got a target of over $80 billion of net new money for 2024 to 2026. Are you confident now that you're going to hit or beat that target?
I mean, we're very much on track. So the guidance that we gave just 6 months ago, we've already surpassed that in terms of the early stages. It's been a good market. It's not been a perfect market. Obviously, we've had challenges in some of the equity markets around the world, and some questions about how the tech sector will perform, et cetera. But against the backdrop of a market which is, I'd say, neutral in terms of attractiveness, we're outperforming. So assuming the market stays neutral, I think we'll do very, very well. If we have a very, very difficult time in the market, it gets tough for a short period of time. But this is a long-term story. And this, we've been growing it at 9-10% for 10 years. And we cover that, and we'll cover that in our earnings presentation in just a bit, that this is a long-term secular growth story. It'll be volatile from quarter to quarter, maybe even from year to year, but the trajectory is very clear, and we're perfectly positioned for it.
You mentioned China, Hong Kong. I wonder whether you're still staying on the sidelines when it comes to Hong Kong mortgages.
So two stories about Hong Kong mortgages. First is they're very safe. We've got very low loan to value in aggregate, so we've got zero concerns. Even with a somewhat soft residential property market in Hong Kong, and it is a little bit soft, we've got no concerns about losses. But the market is extremely competitive, and Hong Kong mortgages tend to be the thing that soaks up surplus deposits. And there is a surplus of deposits in Hong Kong right now. So the margins are actually unattractive in Hong Kong. Our market share we've taken it down deliberately. But we're not concerned about that because the franchise for our customers in Hong Kong is still extremely strong. And we're able to service any customer that looks at mortgages as part of a broader relationship. So we continue to be active, just not as active as we have been in the past. Okay,
we were talking about the stock price. What do you think it's going to take for it to be properly re-rated by the market?
Well, that's a big question. And the first story is for us is to keep on performing. So this performance today will add to that momentum. It's been, if you can draw a line through the interest rate effect of the COVID period, it's been a good steady performance story for 5 years. But obviously we have to demonstrate to the market that it's sustainable in this kind of a rate environment. Everyone expects rates to come down, probably starting in September. That will present some sort of an interest rate headwind, but we've still guided to increasing net interest income because we think we can offset the rate effect with volume growth and with mix shifts in our portfolio. So I think, but we need to demonstrate that. Second, I think that the world will need to recognize that we're not a proxy for Chinese GDP. We are a proxy for the degree to which China opens up, to some degree. We've got a super business in China. We're helping connect China to the rest of Asia, to the Middle East, Africa, to the rest of the world, and vice versa. Those trade links and investment links haven't gone away. In fact, they're extremely robust. So, but the market still sees China as an economic weak spot and is concerned that could spill over to our earnings. Empirically, we're showing it doesn't. So I'm very hopeful that as we just stick to our knitting, focus on those things where we really make a difference, we'll perform, we'll generate the results, share price will follow.
So you're not a proxy for China GDP.
We're not.
You're London listed, but the business isn't predominantly about London. I do wonder whether you expect a lift to the valuation because of the boost from the lack of political uncertainty now, given Labour's electoral win.
Well, it's certainly good to have a stable government in the UK. I think they've, as the Chancellor has made clear, we're working through some challenges, fiscal and otherwise. But certainly all of the rhetoric to this point from this Labour government has been very supportive of a stable business environment, which is not to say that there's going to be giveaways or handouts. There won't be. We don't expect that at all. But predictability in and of itself is a good thing. The last government passed through a competitiveness objective, a secondary objective for the regulators, to focus not just on financial stability, but also on creating a competitive financial sector. These things are working through the system, and thankfully it's a highly sophisticated regulatory environment here, stable politically. That's a good environment for us to have a headquarters.
Okay, good. And just finally, Bill, you're in your 10th year now as CEO. You talk about the long term.
Yeah.
You've said before you've got no plans of going anywhere, and I wonder whether it's your intention to see through this cost-cutting and growth plan until at least their completion in 2026.
Yeah, I'd like to, but you know how these things go. You live it from day to day. But certainly all the actions I'm taking today are with a medium long-term view. I've always tried to be that way. And we've got a fantastic team at Standard Chartered with a couple of new members and a couple of people that have been with us for a long time. So I'm quite sure that what we build in the coming years, we can continue for some time to come. But yeah, my hope objective is to see if we can deliver the strategy.
Well, I hope to be discussing your earnings with you for many years to come. Bill Winters, CEO of Standard Chartered, we thank you for joining us.